Let's kick things off with a number that literally flips the script on everything we think we know about energy extraction costs. $7.70. That's it. That is the total cost for this company to pull a barrel of oil out of the ground.
To put that into perspective, your typical oil companies, like the ones grinding away in the U.S. shale basins, they are spending anywhere from $15 to $25 a barrel. Deepwater players, they're often pushing $30. But AKRBP, they do it for a fraction of that. At just $7.70, we are looking at instant global operational dominance.
Welcome to our explainer on AKRBP. Today, we're diving into a really fascinating business case. We're going to unpack this intense tension between ruthless, absolute operational efficiency and the massive gravitational pull of global macroeconomic cycles. I mean, how does a company operate so flawlessly, yet still find itself totally at the mercy of global markets?
Well, here is our roadmap to figure that out. We're going to look at their pure play model, dig into that structural cost advantage, check out a huge growth inflection coming in 2027, and break down the reality of taxes and oil cycles. Then we'll explore a highly unique dual ownership dynamic, and finally, weigh all that quality against the cyclical reality. Let's get right into it. Section 1, a pure-play E&P powerhouse, laser-focused on the Norwegian continental shelf. So, formed after a massive merger back in 2016, AKRBP made a very deliberate choice. Do exactly one thing and do it perfectly. They are a pure-play exploration and production company. That means zero refining, zero gas stations, and actually zero renewables under this specific umbrella. Plus, they operate strictly on the Norwegian continental shelf. No random assets in the US or the Middle East, just deep, laser-focused expertise right in their own backyard. And man, has that intense focus paid off. Just in the first quarter of 2026 alone, it yielded an absolutely massive 398,000 barrels of oil equivalent per day. They aren't distracted by trying to be everything to everyone. They are just efficiently pumping huge volume out of a very mature, well-understood basin. Moving to Section 2, the structural cost advantage, or as I like to call it, the $7.70 moat.
Okay, so how on earth do they actually hit those production numbers without breaking the bank? Well, AKRBP boasts a staggering 97% production efficiency across their portfolio. That is firmly top quartile globally. Essentially, their infrastructure is pumping oil constantly with virtually zero downtime. When you combine that with their incredibly low unit cost of $7.70 compared to the $15 to $30 industry norm, it creates an absolute fortress of a moat. Even if global energy markets tank and oil drops to $40 or $50 a barrel, AKRBP is sitting pretty and staying profitable while their higher-cost competitors are just bleeding cash.
All right, Section 3. 2027, the growth inflection, and the path to 500,000 barrels a day. They definitely aren't resting on their laurels with current production levels. AKRBP is aggressively targeting a 25% growth step-up by 2028. And we know they can execute. They already delivered first oil from the Simmer project 9 months ahead of schedule. But the real magic happens in 2027. That is the massive release point. We're talking about the multi-billion-dollar Yggdrasil and Valhall expansions finally coming online. These are the mega catalysts that are going to propel them toward that 500,000 barrels a day mark. Next up, Section 4, taxes, capex, and oil cycles, and the 2026 cash flow squeeze. Now, even perfect execution has to answer to the government, right? You can't just drill in someone else's backyard for free. The Norwegian fiscal regime is notoriously strict. They take a whopping 78% cut of profits at the margin. Ouch. But there's a very critical safety valve here called the uplift mechanism. Think of it like a giant tax discount for building new infrastructure. They essentially get a 39% extra deduction on their capital expenditures. And let me tell you, that buffer is absolutely vital right now in 2026, as they hit peak investment, dropping roughly $6.5 billion. But here is the real catch. Despite having literally the lowest operating costs in the world, the company's bottom line is still entirely chained to the Brent crude cycle. Just look at the sensitivity. At $100 a barrel, cash is abundant. Everything is great. But if oil slips to 80, it's just comfortable. Down to 60, free cash flow gets really tight, especially with those massive 2026 investments we just talked about. And at $50 a barrel, the stress becomes severe, and their dividend is probably going right on the chopping block. At the end of the day, you simply cannot outmanage a commodity cycle. Section 5. The dual ownership dynamic, balancing global and local interests. Let's take a peek behind the curtain at who is actually pulling the strings. AKRBP has a really fascinating joint control setup. BP holds about 30%, and the Norwegian conglomerate Aker ASA holds about 21%. What this does is blend the incredible global technical might of BP with the deep local relationships and regulatory clout of Aker ASA. Since neither party can entirely dictate terms, it creates this uniquely balanced, almost delicate governance model.
But there is a bit of a plot twist. These two controlling entities have potentially conflicting long-term agendas. You see, BP is publicly going all in on the energy transition, pushing hard toward renewables. Aker ASA, on the other hand, is firmly rooted in traditional offshore Norwegian oil assets. So the big question is, what if BP eventually decides to accelerate its green transition and divests its 30% stake? That massive block of shares would suddenly overhang the market, posing a very real long-term risk for the company's strategic direction.
Which brings us to Section 6, Quality versus Cyclical Reality and the Dividend Dilemma.
Synthesizing all of this, the rock-bottom costs, the heavy taxes, the incoming growth, and those ownership tensions, what does it all mean for the income? Well, AKRBP currently throws off a massive 7.5% dividend yield. And it's not just sitting there stagnant. It is backed by a frankly staggering 23% 5-year compound annual growth rate. They are, without a doubt, a genuine income powerhouse.
But we have to address the elephant in the room. When you're staring at that robust 7.5% yield, you got to ask yourself, what happens to this payout if global oil prices tumble back down below $60 a barrel? Yes, they've maintained discipline through past weaknesses, but in a sustained downturn, especially right during their 2026 capex peak, that yield is going to be under immense, intense pressure. And this is really the core thesis of today's explainer. It is the ultimate paradox. AKRBP operates almost flawlessly. They execute ahead of schedule. They have totally unmatched cost discipline at just $7.70 a barrel. And yet, they are fundamentally, undeniably tethered to volatile commodity prices and a steep 78% tax regime that scoops up the lion's share of the upside.
Which leaves us with this final, provocative thought to chew on. When we consider the terminal value of fossil fuel assets over the next 20 or 30 years, you really have to wonder, can even the most efficient, disciplined oil producer in the world truly outrun the long-term reality of peak oil demand in the global carbon transition? It's a huge question and a fascinating paradox. Thanks so much for hanging out with me for this explainer, and keep questioning the numbers.